Hey, Saretsky here. Welcome back to the show. There's a few things I want to touch on this week because there's a really important dynamic or a scenario that is playing out in front of our very eyes. It's something that I mentioned on this channel, on the Loonie Hour, maybe 6-7 months ago, which was that I felt the Canadian dollar was going to be the release valve. I thought it was going to be the release valve for the central planners, the Bank of Canada. And so what you might see is, in order to re-stimulate the economy and housing, is that you were going to cut interest rates, the Canadian dollars was going to be sort of the sacrificial lamb, and that was going to be the release valve, sort of re-kickstart the economy. And there's a lot of people on here that, in the YouTube comments, ridiculed me and said, this guy's an idiot. The Bank of Canada can't cut because they're tied to the Fed, and the Fed's not going to cut. And that really has played out to a T, which is to a T that they've done exactly what I thought they would do. The Bank of Canada is aggressively cutting interest rates. The Fed starting to cut rates. They're definitely not going to cut as much as the BOC. That much we know. But the reality is again, guys, private sector debt in Canada is off the charts. It's one of the worst in the G20. This is, whether you like it or not, this is an economy that is highly levered to housing. I mean, housing basically is the Canadian economy and the spinoff from that. Again, you might like it, you might dislike it. I would argue that it's not a great way to build a long-term prosperous economy, but it is what it is. I didn't create the environment. You didn't create the environment. You just play the cards that you're dealt. And so the cards that were dealt is this economy is so highly levered to housing. Bank of Canada was going to be forced, as it slows down, they were going to be forced to cut interest rates faster and deeper than the Fed over in the US. And so that's exactly how it's playing out. As of right now, you've got the BOC, which is aggressively cutting rates, and the Canadian dollar is the sacrificial lamb. It's just touched a 4-year low. The Canadian dollar has just touched a 4-year low against the US dollar, and we're getting calls for more rate cuts from the BOC. You got news articles and economists coming out and calling for 50 at the next meeting, another 50 in January. It's basically just like, how quick and how fast is the BOC going to have to keep cutting rates? And you say, well, again, what about the Canadian dollar? It's going to get so low that you start importing inflation. Yes, maybe, but I think we're a ways away from that. And so ultimately, again, if you're the Bank of Canada, you look at this and you say, okay, let's look at underlying inflation today. If you take CPI, and you X out shelter, so you remove shelter from the CPI basket, it's running at 0.6% right now, 0.6%. Well, people will say, well, hold on a minute. You can't strip out shelter. But let's ask ourselves, what is shelter in real time? This is a YouTube channel that covers shelter on a weekly basis. So let's talk about shelter. Right now, shelter is the largest driver of CPI headline inflation. But shelter is basically just mortgage interest costs, okay, which are falling. They're controlled largely by the Bank of Canada and their interest rate policy. And number two is rents, which, well, they're also falling in real time. But the CPI basket is not aware of that yet. And so as this sort of plays out, you move forward, you say, okay, well, yeah, maybe it is practical to X out shelter because in real time, those metrics are declining. Look at what's happening in Toronto condo rents. I mean, they are plunging. And this is in advance of, we just had an update from the federal government, which says, listen, 1.2 million immigrants a year, we're going to bring that down to zero. We're going to bring that down to zero over the next couple of years as rents are already falling and as you have a record number of new housing that's currently in the pipeline and is going to be completing over the next 12 to 24 months, you're going to continue to see more and more supply coming onto the market, putting downwards pressure on rents. Again, as the labor market is also softening, right? It's hard to pass through higher rents when the labor market is softening, when people's aren't getting the raises they expect, or when they get laid off, it takes them longer to find a job. So as that labor market softens, it tends to impact the rental market first and foremost. And so when I say all this, I think it's logical to conclude that the shelter component of CPI inflation is going to continue to move lower and lower in the months ahead. So the Bank of Canada is not dealing with an inflation problem today. Yes, we had a massive inflation shock over the last 24 months, but today it is not dealing with an inflation problem. It's going to continue to cut rates. And this is what the BOC, the Bank of Canada, Tiff Macklem, was in the Finance Committee just this week, and basically he was asked, and he basically said the same thing, which is, I am not worried about the Canadian dollar. We're not even really thinking about it yet. At some point we're going to have to, but that day is not today. They are. So basically what I'm coming home to say is rents are declining. CPI is still coming lower. The Bank of Canada is going to continue to cut rates despite what the Fed does. And again, the sacrificial lamb, the release valve is the Canadian dollar. So that Canadian dollar is probably not somewhere where you want to be holding your assets in the near term. But that has the opportunity to potentially push home prices higher, at least in nominal Canadian dollar terms. And so what I mean by that is you have to put your macro hat on and say, okay, house prices, they might be going up in, the Canadian dollar, call it the Canadian peso, they might be moving higher. But when you start pricing these houses in things like, my favorite is gold, when you know what's happening in gold, which is real money, house prices in Canada are getting cheaper and cheaper and cheaper. You start pricing it in US dollars, you might see no real growth in Canadian home prices adjusted for inflation and adjusted for the devaluation, the depreciation in the currency. And so I think this is big picture thinking. There's a lot of variables that go into it, but that's kind of where my headspace is at today, is I think that what we're seeing right now is we're seeing the Bank of Canada aggressively cut rates. They said they want to re-stimulate housing. They have residential investment moving 6% higher in their forecast. You've got Chrystia Freeland, the finance minister of Canada, trying to ramp up leverage, saying, hey, listen, CMHC jumbo mortgages, $1.5 million, will insure them. You go out and buy them. So they're trying to re-stimulate housing activity. And that's what we're starting to see. We're starting to see that in sales volumes, not only in Vancouver, but in the GTA as well. I'll be chatting about that with my friend of the show, John Pasalis, next week. We're seeing that uptick in housing activity. It's coming off the lows. It's increasing. It's increasing in line with consumer sentiment. Consumer sentiment in Canada just hit a 30-month high. Yeah, rate cuts do magic for a highly levered household sector, which is we need lower rates. Lower rates are happening. Consumer sentiment hits a 30-year high. Housing activity picks up. And so, the days of these aggressive low balls is starting to fade away. That's what we're seeing in the market in real time. It's like when the sentiment starts to shift and people think, well, maybe things will be a little bit better in the very, very near future, you kind of lose some of that ability and that leverage to go out there and negotiate. You lose the leverage to really aggressively lowball a seller. So it's starting to come out of the market. There's still pockets of weakness. Again, I've talked about the new construction space, but again, even if you see an increase, let's say, in home prices next year, keep in mind, you have to start adjusting for the currency, okay? So if the Canadian dollar is, say 72 cents today, and maybe next year it's 69 cents, it's like, okay, well, your house prices, again, are going up in Canadian dollars, but you start adjusting it out for, gold or the United States dollar. You start pricing it in different baskets, shares of the S&P, prices of Bitcoin. You'll see that Canadian home prices might actually be declining in real terms, adjusted for things outside of the Canadian dollar, because you have this internal devaluation. You have this household balance sheet recession that we're currently in, and the way that they're going to get out of it is, I think they're telling you what they're doing is they are devaluing, they're depreciating the Canadian dollar. So yes, home prices, home activity could rebound, probably is going to rebound, is in the process, in my opinion, of starting to rebound, and might start recovering those prices. But again, I think you have to zoom out and say, well, are they recovering in what terms? And so for not only adjusting for inflation, but adjusting for the devaluation and the depreciation of the currency might not be going up as much as you think they are. So that's kind of where my headspace is today. I'll be watching central bank policy moving forward. Another little tidbit for the BOC this week. You had Canada's GDP for the month, again, came in very, very soft. And as we know, we've talked about the population side, assuming that it goes to zero or close to zero, as the feds are telling you, that will shave off about 1% of GDP next year. So a very weak, slow, soft economy that, again, is going to see its release valve through the currency side. And so that's kind of where my headspace is at today. I think you want to own things outside of Canada. And yeah, food for thought. So as always, hope that helped, and we'll see you next week.